The year is 2025. The digital asset landscape feels familiar yet fundamentally altered. Bitcoin continues its journey marked by its signature volatility and a growing global conversation. But if you look closer, the ground beneath has shifted in profound ways. For investors, enthusiasts, and even skeptics who have watched from the sidelines, a simple question emerges. What really changed? What makes this moment different from the cycles that came before it? The answer is not just one thing, but a powerful convergence of events that have reshaped the very structure of the market. This is not just another year in Bitcoin's history, it is the beginning of a new chapter, one defined by new rules and new players. The story of 2024 set the stage for everything we are seeing today. Two pivotal events occurred that are now echoing through the financial world. First, the introduction of spot Bitcoin exchange-traded funds, or ETFs, in the United States. This development was more than just a new product, it was the construction of a bridge connecting the world of traditional finance, with its trillions of dollars in managed assets, directly to the Bitcoin network. It made owning a piece of the digital asset as simple as buying a stock through a standard brokerage account. This unlocked a new level of mainstream access and legitimacy that had been discussed for over a decade. At the same time, another more predictable event took place. The Bitcoin network experienced its fourth halving. This is a core feature of Bitcoin's design, a pre-programmed reduction in the rate at which new coins are created. Every 4 years, the reward for miners who secure the network is cut in half. This event directly impacts the supply side of the equation, making new Bitcoin scarcer. The combination of these two forces, a massive expansion of potential demand through ETFs and a simultaneous contraction of new supply from the halving, has created a market dynamic unlike any seen before in Bitcoin's 15-year existence. It is this unique intersection that we must understand. In this analysis, we will unpack the current state of Bitcoin. We will start by revisiting the key milestones that brought us here, examining the impact of the ETFs and the halving in detail. Then, we will explore the forces driving the market right now, from institutional capital flows to the subtle signals hidden on the blockchain itself. Finally, we will look ahead, outlining potential scenarios, base, bull, and bear, to help you navigate the road ahead. Our goal is not to predict the future, but to provide a clear framework for understanding the present. This is your guide to Bitcoin in 2025 and beyond. Understanding the current market requires a clear lens. We must separate the noise from the signal. Daily price fluctuations, social media chatter, sensational headlines can obscure the fundamental drivers. Focus on supply and demand. What forces influence available supply? What factors drive demand? Break down to basics to build a durable model. The first part, a deep dive into what changed, how spot Bitcoin ETFs work, why approval was a landmark, structural integration into legacy finance. These funds opened access for new investors, individuals using retirement accounts, large institutions seeking diversification. Alongside that demand shock, the fourth halving, how it mechanically reduces new supply. Long-term implications for scarcity and store of value thesis. Now, the present. Analyze real-time drivers. Look at the data, daily net flows into ETFs, weekly net flows into ETFs. Institutional sentiment signal. On-chain, long-term holder behavior. On-chain, dwindling exchange reserves. Clues about supply availability. Macro factors, inflation, interest rate policy, global liquidity conditions. The future, explore plausible scenarios. Base case, steady institutional adoption and moderate growth. Bull case, positive catalysts align and push into new territory. Bear case, regulatory headwinds or economic shocks. For each, note the key signals to watch. Build a durable mental model for unfolding events. The base case scenario is one of constructive, measured progress. It assumes that the major trends established in 2024 and 2025 continue on their current trajectory without dramatic acceleration or reversal. Spot Bitcoin ETFs continue to see net inflows, but not at the frantic pace of their initial launch. Flows become cyclical, weeks of strong buying, periods of consolidation, and minor outflows. This is institutional allocation and retail allocation via traditional brokerage accounts. Less of a flood, more of a persistent rising tide, gradually absorbing supply. Price action, sideways to up, not parabolic, a grinding ascent with higher lows. drawdowns of 20 to 30% remain possible, but recoveries are resilient, backed by durable buyers. On-chain holders stay firm. Bitcoin on exchanges trends downwards or stays flat at historically low levels. Miner selling stays predictable. Miners sell to cover costs, not mass capitulation. Macro, neutral to mildly supportive. Inflation moderates, keeping the store of value narrative relevant. Interest rates may slowly decline, but no dramatic rate cuts to trigger broad speculation. Result? Bitcoin carves its own path, driven by supply and demand dynamics. A maturation story of steady, defensible growth. So the bull case scenario envisions a future where, the existing positive drivers are amplified by new, powerful catalysts. It all begins with a significant reacceleration of inflows into the spot Bitcoin ETFs. This could be triggered by a second wave of adoption, as pension funds and sovereign wealth funds begin to make their first strategic allocations. This renewed and massive demand would quickly overwhelm the daily new supply from miners, creating, intense buying pressure on the open market. This surge in demand would be further fueled by a distinct shift in the macroeconomic landscape. In this scenario, central banks, faced with slowing economic growth or maybe a minor financial shock, pivot to a much more accommodative or softer monetary policy. This would likely involve definitive interest rate cuts and potentially new liquidity injections into the financial system. A key element of the bull case is the entrance of a new class of buyer, the corporate treasury. A single announcement from a major S&P 500 company allocating even 1% of its cash reserves would act as a massive validation, likely triggering a cascade of similar moves from other firms. The on-chain data in this scenario would reflect a severe supply squeeze. Exchange balances would plummet to new all-time lows as every available coin is acquired and moved into long-term cold storage by ETFs, corporations, and individuals. The momentum would become self-reinforcing. Rising prices would generate positive media headlines, attracting more retail and institutional interest, which in turn would drive prices even higher. This is the scenario where all positive forces synchronize, creating a powerful and sustained upward trend. Prudent analysis requires a clear-eyed look at the potential risks. The bear case outlines a future where negative factors converge to undermine the market. The most potent catalyst would be a significant policy shock or a harsh regulatory crackdown. That could include efforts to restrict access to Bitcoin, or imposing prohibitive taxes on transactions or gains, or placing limitations on the operations of ETFs and exchanges. A move like this from a major power, the United States or the European Union, would severely damage investor confidence. Another primary driver is a severe macroeconomic downturn or recession. Bitcoin's correlation with the tech sector, particularly the Nasdaq, could flip from a benefit to a liability. Technology stocks fall, Bitcoin falls in tandem. That shift would show up clearly in ETF flows. We'd see a sustained period of net outflows as investors de-risk. Reflexivity works in reverse. Falling prices trigger more outflows, causing more selling and lower prices. This would be exacerbated by stress on Bitcoin miners. Miners would be forced to sell newly mined coins. They might also liquidate existing treasury holdings. On-chain metrics would turn negative. Long-term holders who held for years could begin to sell in large numbers. The amount of Bitcoin on exchanges would begin to rise as investors move coins into sell positions. A confluence of regulatory hostility, a global recession, and a reversal in market structure could lead to a prolonged bear market. To effectively navigate the scenarios we've outlined, it's essential to move from theory to practice. This means building a simple, personal dashboard of key indicators to check regularly. The first, and most important component, ETF net flows. Track capital flowing in or out. That shows institutional sentiment and market demand. The second core component, Bitcoin balances on exchanges. It's a barometer of holder conviction. Continued decline or flat low trend suggests strong propensity to hold, supportive for price. An upward spike can be an early warning of selling. Next, add two derivatives indicators, options skew and funding rates. Options skew measures demand for calls versus puts. Positive skew. Traders betting on upward movement. Persistently high positive funding can signal overexuberance and correction risk. Finally, include a macroeconomic calendar. You only need basic awareness of key dates. Mark the Consumer Price Index release. Mark central bank policy meetings, especially the U.S. Federal Reserve. Knowing these dates helps anticipate volatility. ETF flows, exchange reserves, derivative sentiment, and the macro calendar. That's really all you need to stay informed. While navigating price scenarios is a critical skill, a truly durable approach to Bitcoin requires an equal focus on managing risks that exist beyond the charts. The most fundamental of these is the risk of custody. The phrase, "not your keys, not your coins," is a timeless principle in this space for a reason. Exchanges being hacked, exchanges failing, resulting in a total loss of customer funds. True ownership in the Bitcoin network means holding your own private keys, a responsibility that requires diligence and education, but offers the ultimate security and sovereignty over your assets. Another significant risk, especially during periods of market excitement, is the misuse of leverage. Leverage is a double-edged sword. It magnifies losses just as powerfully as it magnifies profits. A sudden price correction, which is a normal occurrence in the Bitcoin market, can trigger a forced liquidation of a leveraged position, wiping out your entire capital with breathtaking speed. We must also guard against the psychological risk of overconfidence, which often peaks near market tops. This feeling of euphoria is often the most dangerous signal of all. Finally, the evolving regulatory and tax landscape presents an ongoing and often complex risk. The rules governing digital assets can differ significantly by country, and even by state or province. Ignoring these responsibilities can lead to significant legal and financial penalties down the line, turning investment gains into a source of unforeseen trouble. The antidote to these risks is not fear or avoidance, but discipline. Building a robust safety strategy is just as important as building an investment thesis. The first pillar of this strategy is self-custody. This means investing in a reputable hardware wallet, a small physical device that keeps your private keys completely offline, away from the reach of online hackers. The second pillar of discipline is prudent position sizing. Never invest more than you are truly willing to lose. Another powerful rule is to maintain an emergency fund in cash, completely separate from your investments. A crucial, though less tangible aspect of discipline is what is often called the sleep-at-night rule. If you find yourself constantly checking the price, feeling stressed by minor dips, it is a clear sign that you may be overexposed or have taken on too much risk for your personal comfort level. It is the consistent application of these safety principles, securing your assets, managing your position size, and maintaining emotional equilibrium, that separates successful long-term investors from short-term speculators. By approaching the asset with the same rigor, caution, and discipline that you would apply to any other serious investment, you can navigate the road ahead with confidence. As we look toward the next quarter and beyond, the Bitcoin story is one of a market at a fascinating crossroads. The foundational shifts of 2024, the creation of the ETF bridge to mainstream finance, and the programmed reduction of new supply from the halving, have set the stage for this new era. The road ahead will be defined by the interplay of these powerful new dynamics with the enduring crypto-native fundamentals and the ever-present influence of the global macroeconomic environment. The key to navigating this future is not prediction, but preparation and consistent observation of the signals that matter most. In the coming months, your focus should remain squarely on the key drivers we have explored. Continue to watch the daily ETF flows, keep an eye on on-chain data, particularly exchange reserves, and stay aware of the macroeconomic calendar. These three pillars, institutional flows, on-chain fundamentals, and macroeconomics, form the essential toolkit for understanding the market's direction. They are the compass and map for the journey ahead, helping you to contextualize daily news and price movements within the larger unfolding trends. By now, you should have a clear framework for thinking in scenarios: the steady ascent of the base case, the breakout potential of the bull case, and the cautionary tale of the bear case. This approach empowers you to think critically, manage risk effectively, and engage with the market from a position of clarity rather than confusion or fear. The road is laid out before us, and now you have the tools to follow it. If this clarified the road ahead, comment your base bull or bear scenario, and subscribe for the next chapter.